welcome you all to St. Louis Real Estate Investors Association's Spring Fling 2022. It's good to get back together again. Some of our members have been around a while, and I haven't seen faces here. I haven't seen live for 2 years, over 2 years now. So it's great to see your faces again. Get back together and share a meal. And thank you to our caterers, Genesis Catering. Great. Let's have a round of applause. Thank you. Really appreciate it. And if you sign up for our Saturday seminar, you're going to get a chance to taste their box lunches also, because we're going to get box lunches from Genesis also for that event. As I mentioned, we got flyers on the tables, so take a look at those, and hope you can join us on Saturday. Anyway, first of all, we usually go through see how many first-time visitors do we have with us tonight. Have we got any new first-time people here? Here we can stand up so we can see where we are. Okay, okay, got a handful. Let's give a round of applause. Hey, I think you made a great decision being here. You're going to be involved in real estate and investing. You're going to start getting out to a good start here. Thank you all for coming. I hope you enjoy the evening. Also, yeah, I want to welcome everybody that's here on Zoom too. Sorry you couldn't be here to enjoy this wonderful meal. You know, it's you're missing out, but glad you're with us anyway, because you're going to hear a great presentation from Kevin. And by the way, Kevin, he's been involved in real estate. Started out in 1985 as a commercial real estate appraiser, and through mentoring and partnership, he's been involved in both the real property end of real estate investing and also in the paper end. He has purchased, renovated, and resold over 150 properties, and has been involved in, has transacted over $30 million worth of note transactions. So, and I personally recognize him as one of the best note educators I have heard. I spent, back in the time frame of 2013, 2014, I spent 2 weekends in intensive note education. And when the board started talking about what a presentation that we have, Kevin Shortle was mentioned, that was the only name that I could remember out of those 2 weekends. The only speaker that I could tell you name by name that was really sunk in. He's a great educator. He's got a way of presenting that you don't forget it, gets into the details, and make sure you understand. And he's really good at that. And so I was really thrilled when two of our board members, Jim Choik, where's Jim? There he's Jim Choik over here, and John Lee in the back were able to secure him to come as a speaker for our spring fling this year. So please, let's give a warm St. Louis welcome to Kevin Shortle.
Thank you, everybody. Thank you very much. And I do appreciate the board members inviting me. I'll tell you, there's something about speaking in front of live audiences again. I did my first one in a long time. Well, since COVID, I did my first one in Phoenix last weekend. It was just great. There's a whole different energy and everything like that. So I've got a lot of things prepared for you this evening. Feel free to take notes. Normally, I would take questions and answers as we go through, and I may do a little bit of that because I don't want you to be lost on certain things. If you do have a question, just throw your hand up there. Let me finish my train of thought and just kind of say, give me 1 second, and then I'll come back on your question. But I am going to, because of the time that we have tonight, I am going to possibly say some of those questions, great question, but you know what? If I cover that right now, it's going to take us totally off target here. So there may be some things as we go through, but if you have questions, certainly by the end, we can take a Q&A session, and I'll be glad to stick around and answer those questions as well. And if you join us on Saturday, we'll have a lot more time for that, because the way I do teach is just like that. Ask questions, let's go through. I want you all to have all the answers that you need for that. So great to be here. Somebody already talked about my background, so I'm not going to go into that too much at all. But it's a pleasure teaching people this business. I've been doing it for almost about 30 years right now. I've been an educator for about 25 years, and it's just been amazing to see this industry that started as a niche. I mean, it was just a pure niche when I started. I mean, we didn't even have the internet. I used to go to the courthouse and search for people who might own notes and send out direct mail and see if they would be interested in selling their their note, and that's how you really did the business. And we worked with a lot of big vendors. I didn't have money to invest in notes at the time, but what I learned early on is, and I repeat to this day, is the most valuable skill that someone needs to have, whether it's real estate or real estate notes, is really just the ability to identify a deal. Just remember that if you have the ability to identify a deal and possibly be able to present that deal to somebody as well, the money and everything else is there. The opportunities will start to show up in that business as well. So when I started from that, it was just a small niche within real estate. And the reality is, it's simply the financial side of real estate. Whether you're creating loans with seller financing, whether you're lending money, whether you're buying money that's already been buying loans that have already been created, whether you're working out loans, whether you're foreclosing upon loans that simply have no other solution to them, that's all a part of the note business. So the note industry really is the opposite side of the same coin for real estate. And I think what you will find is you will be a more complete real estate investor if you have knowledge on the financial side, which is the note side as well. And that's the point of reference I like to talk about. To see it grow and become something from a niche to where you have people like Robert Kiyosaki. Now, whether you like his teachings or not, he does have a high profile in the industry, and in all of his latest books, he's listing in their notes as a part of what everybody should have in their investment portfolio. And I can tell you, I've recognized that over the years as well, because more and more people who are coming from the stock market and the bonds and all those sorts of things are looking for investment alternatives right now, and a lot of them turn to notes. Notes has become more popular for people with IRAs and 401ks as an alternative investment than even real estate has. So it's truly grown into its own asset class, which is great. Another quote by him, which I really like because it fits notes to a T, is this: to obtain financial freedom, one must either own a business or an investor or both, generating passive income, preferably on a monthly basis. And that's exactly one of the things that the note business can do for you, as it has for so many other people, because we are also in what they call the cash flow business. And I think what you'll find is cash flow, especially in today's economic environment, is going to be more predictable than appreciation and everything else. So it's nice when you have that cash flow without some of the responsibilities that most of you are familiar with on the landlording side of the business. So we'll get into that for you as well. So investing in performing loans can provide you, and I'm just going to do a little list here because I know we have some folks who are new to this. So passive monthly income, high return on investments, we're talking double-digit returns, low risk, because everything that we invest in is backed by something of higher value. That's the whole point. When you buy a note, you're essentially buying debt. And that debt is backed by a piece of property. It might be vacant land, might be single family home, commercial property, whatever. It doesn't matter what that is, as long as you can evaluate what is that collateral worth. Because if I don't get paid on my loan, ultimately I could end up with that collateral. And that's what protects us. That's what makes us safe. Now, obviously, how you invest and how you bid and how much and the various ratios and things like that, we'll talk about. So high returns on that, low risk, and you also have diversification. I've done a lot of real estate myself, and I totally believe in real estate where you have certain key target areas. It makes sense to me, as it does to many of you. I used to buy a lot of HUD properties. I specialize in HUD properties, and there was a reason in Florida, where I'm from, we had it was a national program and a local program combined. The national program with HUD, I found a way deep inside the HUD manual, if you will, where I could partner with a nonprofit entity, buy directly from HUD with the nonprofit entity, getting 40% off the normal price. And my bidding priority was before anybody, before investors, before even homeowners. And if you buy 10 at a time, you got another 10% off. So I said, well, that sounds good. And I targeted those areas very specifically in a 3 mile by 9 mile rectangular area in Central Florida, where they have a down payment assistance program, where people who are buying the homes from me in that area walked into a closing with a pen because they got a $20,000 grant on about $120,000 property. So setting things up like that in certain areas makes a lot of sense to me. Also, I like the systematic approach to things like that and doing things uniquely within the industry. And I've got a whopper of one for you tonight that's going to apply to the note business as well. And I've saved that kind of towards the end as it flows through here for you. But with the note business, you really start to think more like a bank, more like a lender. And the lenders go to where the opportunities are. Now that's really the name of the game. We don't localize things really in the note business. We go where are the best opportunities? Where can I lower my risk? Where can I maximize my investment? Some people are afraid about, well, what if I have to take a property through foreclosure? What if they don't pay on the loan and I have to foreclose? I have no choice. Well, you can target certain states. For example, with my personal clients, I have told them for the last year, stay out of New Jersey right now. It takes 4 years to foreclose in New Jersey right now. 4 years, 2 years, 2.5 years in New York. So I said, watch those areas. Now, there are something called the silent foreclosure position, but that's a little bit more above and beyond what we have here today. But there's other states such as Georgia. Georgia takes about 90 days to foreclose and costs maybe $800. So there are reasons why geographically you would look for things and be able to diversify within the categories. But what you'll find is, as it's been since 2008, the best markets are going to be in the Midwest and the Southeast. That's where the bulk of the note business takes place. And there's reasons for that, probably too many for me to go into right now. We do have more liquidity in this industry as well. If you buy a performing note and something happens financially in your life and you go, I need cash. The cash flow is good, but I got to cash out for emergency or for whatever reason it is. You can turn around and put that note on the market, and if you have the note properly, you have all the paperwork and everything else, you'll be able to sell that note very quickly, okay, without having to suffer through a big discount if things are done correctly. So we do have the ability, by the way, to sell notes in their entirety or just a portion of that income stream. We have all of this on the performing side of notes without property management, without property maintenance, and of course, without the ownership liability as well, because we don't own the property, we own the debt on the property. Okay, so if you have a loan on your house and something happens, you got somebody slips and falls or something like that on your house, you have liability insurance. You're the owner, you have the liability. Your bank doesn't, right? You don't call Bank of America and say, hey, the roof is leaking, send somebody over, because they're not your landlord. So we own the debt on the property, not the property itself. However, the property is our collateral if we're not paid on the debt portion. On non-performing notes offer different opportunities. You do have to be more active with non-performing notes, okay? And because we have a room full of real estate investors, I liken non-performing notes really as a rehab property. You all are familiar with rehab properties. You know, when you're looking for rehab property, what are you looking for? Well, you're looking for a good house in a good area that's not in full repair, it's in disrepair. Because you know you can buy that inexpensively, you can fix it up, and by the way, you can project how much it's going to cost to fix it, of course, right? You project what it's going to be worth after you fix it, of course. We can do the same thing in the note business. We can buy a note that is non-performing, meaning people aren't making payments, and it might be 6 months, it might be 12 months, it might be 24 months or more. There was a period of time we were buying notes where people hadn't made a payment in 5 years. Okay. Not so much anymore, but after the last real estate crash, we certainly did that, but we bought them at a substantial discount. You might have paid back then $20,000 back by a $100,000 home. And they probably owed $120 on it. I'm thinking, how do you make money doing that? Well, if we can get that note reperforming again, have we added value to the note? Sure. That's one way we can do it. So we can do workouts, we can do resolutions. We can, if we have to, some of those homes were vacant, and that became just another way to buy real estate. It's becoming increasingly difficult for probably everybody in this room, and really nationwide, to find a good deal on a property, something you could buy inexpensively and quickly. It's getting harder, isn't it? Yes? No? What are you experiencing? So it's more challenging today. I'll show you the numbers for foreclosures. During 2021, there were 2 months, 2 months where we had over 5,000 homes nationwide, I'm talking about, that were foreclosed on. So we were having As a country, less than 5,000 foreclosures every month. Now, a lot of that was what? Moratoriums that they put on, things like that, the government came in and said you can't foreclose on people. But statistically, what you're going to find in foreclosures is really not the place to go to find real estate in almost all cases. Buy the non-performing note, end up with the real estate. Less competition, cheaper prices, and most of your competitors don't even know you can do that. So it's another way to purchase real estate as well. Once again, high return on investments through loan mods, ability to purchase real estate, as I just said, and the ability to create safe, high yielding seller finance notes after property acquisition. So many of you do property acquisitions, and if you ran numbers against long-term thinking, you would make more money seller financing today than taking, somebody just selling you you selling the property one time to someone. Because another unique thing in the note business is if we're buying a 30-year or creating a 30-year income stream, I can take that income stream and sell that 4, 5, 6, 7, 8 times. Not the whole income stream, parts of it. I could sell 5 years of my note, right? Get a lump sum. Sell after that comes back to me. I sell another five years worth of the notes. And what you'll find is because of the time value money, there's many cases where you can sell enough of a part of a note for what you pay for the entire note. Think about that. That's where you're starting to see some returns that you can't even calculate. So without foreclosure sale competition, as I mentioned, and without geographic restrictions, once again, you can do this anywhere. Most of it is going to be in the Midwest and the Southeast. There'll be pockets of the Southwest and Northeast in here as well. What do you think? Are we going to see more non-performing loans coming up? Just instinctively, you kind of know that. Why? Interest rates are going up. They still started doing some adjustable mortgages. Those folks are going to get caught. You're going to see some commercial notes going up. Inflation is going up. So we're probably going to see more of these non-performing loans. And you know what? People are going to need our help. That's another thing we can do in this business. And I'm going to show you at the end a way that you could get up to $50,000 paid to you, the note holder, regardless of what you paid for the note, to help those people stay in the home. And it doesn't cost them anything, if we have time. Okay. All right. Investing in real estate backed notes. So again, for those who this is brand new to, let me try to slow down a little bit so you get an idea here. What is a note? A note is a promissory note. It's just an IOU. You're promising to pay somebody back. And the note will simply outline what is the loan amount, what's the interest rate, what are the payments due, what's the penalty if you pay it late, what's it backed by, what property, in other words, what's the interest rate, all those sorts of things are on the note. So if you go to a bank to get a loan on a property that you're buying, you're going to sign a promissory note promising to pay it back. Is that good enough at a bank to get a loan on a piece of real estate? No, they're going to say, and we need some kind of security agreement. We're going to need a mortgage, or we're going to need a deed of trust. And the mortgage or deed of trust simply says, if I don't pay you back, according to the note, then you have the right to foreclose or the right to sell the property, depending if it's judicial or non-judicial. So we buy secured notes. It's called the note business, but we don't just buy notes because notes by themselves don't have collateral. We buy the notes with the security agreement. And it's very important as we go through, especially on Saturday, when I really take real deals and go through all the paperwork and everything else, that we understand what's in these documents because it has all the rights and obligations of both the borrower and the lender. And that's very important going in. As you all might have experienced this before. I know nobody in this room would do this themselves, but I have actually seen people at real estate closings at a table, just signing document after document, not reading anything. Have you guys seen this before? Everybody in this room is guilty of that, right? Including myself. Well, this document, okay, okay. They're just rattling off here, signing like this. And with real estate investors, that's one of the habits I have to tell them. I'm going to break that because we have to know what kind of security agreement this is, because there's another hybrid in there called a land contract or agreement for deed, and those can be a little bit different. So we need to know the rights and the obligations. It's a part of our due diligence. It's just like you're looking at a rehab property. You're looking for what needs to be fixed here. What's it going to cost me? What are potential pitfalls in this property? We do the same thing, but through the notes, which also means we do this business through our computer. I'm not driving around I'm not jumping in a plane. Calling Jim up, fly me over to Oklahoma so I can look at this property. It's going to back my note. I don't see the properties other than pictures. Now, that's another thing that can be a little bit off-putting initially for real estate investors, because touchy-feely, got to see everything. You'll get over that pretty quick. And then when you see the numbers and you see the deals. But today, how hard is it to get boots on the ground literally anywhere? Are there real estate agents pretty much everywhere? Are there people that can do appraisals and BPOs pretty much everywhere? Can title companies do title searches pretty much anywhere? Sure. So I don't personally look at the properties, but we do have boots on the ground that does. So all of these things we're going to fully investigate before we buy. Properties collateral for the note, as I said in this. So it visually looks like this. You own the note, there's the property, you don't own the property, you're just getting the cash flow like a landlord without all of the other things that come along with that. And again, I'm not saying anything wrong with being a landlord. I'm not one of these note people that says notes is the only way to go. There's a lot of money to be made in landlording too, but I can tell you what, I work with a lot of frustrated landlords, okay? They come over to the note side. A lot of them have converted their tenants into property owners, especially in a time like right now, peak prices. Y'all just said earlier, you think prices are gonna go down. Why not lock in that equity now? Why not create a couple of notes in here, that sort of thing. So the note owner collects the income, no tenants, no management, no maintenance, and of course you can do it through your IRAs, 401ks, all the self-directed account, because it is an allowable investment. Then you get all those returns tax-free or tax-free. All handled, by the way, through a servicing company. So the servicing company collects the money. If there's taxes and insurance in that monthly payment, they hold the escrow. They make sure the taxes, insurance, and everything else are paid. You can log into your account with a servicing company and see when the payments came in, how they've been applied. They do all the accounting on that, all for about $15 to $30 a month, depending upon what services you have. Pretty sweet deal. Okay. So when it comes to these note and security agreements, again, we've got performing and non-performing. What can we do on the performing side right now? Is there a real opportunity in today's market for performing notes? Where are the prices? I work personally with clients. I have a unique way of working with people. I work directly with people on Zoom. So all my clients talk directly to me, not outsourced to somebody else, anything like that. They work directly with the experts. So I'm looking at notes really every single day with my clients and going through this. So these are all recent deals. This is a property that's valued at $34,500. It's in Cleveland, Ohio. My client paid under $20,000, just under $20,000 for that note. That's 0.23%. And they did that after being in the business for less than 30 days. Couple of things in there. Do you need a huge amount of money? No. They paid under $20,000. I believe this one was in an IRA or 401k. Do you need a whole lot of experience to find those? No, not if you have the right person showing you where this is and walking you through the deals. Okay, they went in with a lot of confidence in these things, going through the paperwork, evaluating what the collateral is, which was $34,500. Is that a pretty safe investment, by the way? Yeah, you invested $20,000. Property's worth $34,500. The property value goes down to $30,000. Still okay? Another weird thing in the note business, your risk goes down every month, typically. You're being paid back on the loan, so the balance goes down every month. And normally, property values are going up. They're peaking off right now, probably going to come down a tad. I'll go into that. Here's another one, a couple months, oh no, this was about a month ago. No, a couple months ago on this one. And I'll tell you why. Property value 35, it's over in Springville, $22,500 on the purchase. She purchased 163 payments to 344. That's a 16% return. She kept that note for 3 months and then sold the whole note to somebody else just to cash out, because she had another piece of property that she bought, got into a bad deal on the real estate side, need to cash out the note. So again, liquidity within that, she still made a great return on that property as well. This one, typical model that you'll find in the note business on the performing side, a property owner got in trouble, the property was foreclosed upon. And a real estate investor comes in, buys that property. They renovate the property, they turn around and sell it. Oh, in this case, that's right, this was as is, my bad. Sold it as is with seller financing on this one. The gentleman who bought this owns a business, and he was converting this from a single family home to an office building, to office space, my apologies. So he's going to use that single family home as office space for his business. And we looked up his business and all that pressure washing stuff, and he's running a really good business there. So he didn't want all the work done like a house. So it worked out really well where they sold this as is for $45,000. Now the house is worth about $100,000 as an office, and he had the zoning redone and everything else. So the person who created this note, the $45,000 note, not only did they get a $15,000 down payment with that, the $40,000 note, there's the settlement statement. So again, we look at all of the documentation here. The person did put $15,000 down on a $50,000 purchase. Is that a good down payment? Yeah, we're starting to see bigger down payments in seller financing, by the way, and I've got the stats on that for you as well. So he's got this $45,000 note. He seasoned it a little bit. Now, he was self-servicing it, and that's one thing that a lot of for sale by owners do. And there's some drawbacks to that, but we can work around those things. He couldn't show us a payment history on like an Excel spreadsheet or from a professional servicing company. All right, well, how's he paying? Through PayPal. Shows your PayPal statement. And that was good enough for us because we could verify the date and the time on all of that. So by the time my client found this note, there were only 14 payments left, plus a balloon of $20,915. Now, for those who don't know, a balloon payment is a technique that's used to lower somebody's payments to say, we're going to make the payments as if you were paying over 20, 30 years, wherever the case is. But in the 5th year, in the 7th year, in the 10th year, whatever, the entire principal balance is due. Okay, that's what a balloon does. So the gentleman who owns the business, right, and is making these monthly payments on time every single month, by the time my client bought it, there were 14 of those left and a balloon of $20,000. He got the whole thing for $20,000. And the guy is still paying on just automatically on time. I mean, I think he just has it set up through whatever, it's just going right through. And so he'll be looking at a balloon coming up. What happens if he doesn't pay the balloon? Yeah, sure. Could we push it back? No, we can push the balloon back. Just continue to collect the monthly payments. On this, we can renegotiate the deal from scratch simply because, hey, it's due, we can't pay it. Why don't we do this? Give me $5,000. We'll reset the loan. We'll do it this way. There's a bunch of things that we can do if it doesn't come back in the form of a balloon. I think in this case, we ran a bunch of scenarios, and it's almost, you don't want them to pay the balloon. Let's do it another way and keep it going because the interest rate on that was pretty good. So today with the note opportunities, and I'm going to show you some stats, by the way, that back this up because I really want to change your mindset on how notes really should be incorporated into what you're doing as an investor. So with the current marketplace, I just did a state of the industry on this at the Noteworthy event, which is a national event last week. The note opportunities that I have available today and not limited. I'm going to do a whole list here. Don't write it down or anything like that. I'm not going to be able to cover all of these obviously today, but I will cover most, if not all of these on Saturday. Note arbitrage. Note arbitrage is that same technique that really focuses once again on ability to find a deal and put it together with somebody else. One of the companies that I invited to the national event last weekend was First National Acceptance Corporation. First National Acceptance Corporation is backed by a bank. They've been buying real estate notes for 40 years. They buy, they hold, they don't sell. They've got $4 billion in their portfolio now, not 4 billion notes, but $4 billion worth of notes. They still buy about $9 million of notes per month. Half of their business is dependent upon people just like you finding a deal, bringing it to them, and creating what's called a spread. That's all you have to do. Find the deal, bring it to them. Let's say you find a deal and you bring it to FNAC and they say, we'll pay $50,000 for it. You go back to your seller and you say they'll pay $45,000 for it. You already know FNAC is paying $50,000. They're accepting $45,000. There's a $5,000 spread that you just made in there. Not a bad way to make a few bucks, learn the business as you go through on that. And there's other buyers, but I'm just pointing that out. You're just utilizing that. You guys have seen that wholesaling of real estate, right? You have a bird dog network, right? They go out, they find a deal, they get in front of you and a bunch of other people, and you pay a little bit more, and they make the fee. Everybody's familiar with that. That's the same thing in the note business. Turnkey notes. We've got a lot of turnkey notes that passive investors really, really like, and for good reason. Turnkey notes, by my definition at least, is they've got at least 2 years of seasoning. Seasoning is a payment history. So a 2-year track record of making payments. I want to see at least 30% equity in that property. And if they have that, and I'm assuming the paperwork is done correctly and everything else, that is a turnkey note by definition. It's plug and play. You buy it this month, you start getting payment, you close on it this month, you start getting payments next month. And statistically, when you look at a 2-year payment pattern, they're going to continue to pay on that, and it's safe. We have a lot of those in the marketplace now from the last crash, where people bought non-performing notes, they got them reworking, and they've been reworking for years. We're talking 7, 8, 9, 10 years of payment history. Property values have been going up. They owe $30,000 on a $100,000 house now. You're buying that note, you're making 10, 11, 12% interest. Hard to lose on that one. You'd almost have to try to lose on that one, right? So those are available. Buying partials, okay? As I said, these represent long-term income streams. I don't have to buy the whole 30 years of payments from somebody. I could just buy the next 70 months, the next 35, the next time, which also means you can sell those as well. Popular way to do it. By the way, done correctly, buying part of the note, you're in a lower risk position versus what the collateral is worth. You're in a senior position, meaning you get paid first, and your yields are actually higher. Hello? I just had a big meal. It's a little. All right. Lease purchase notes. This is another thing that real estate investors like to do. You know, rents are up right now. We can lease it. We can when we do these, we purposely do it on the 13th month. They can exercise their option to buy the property with or without financing. We give them that option as well. Most of them take the financing option. That puts us, by the way, into a lower tax, long-term capital gains after 12 months. So you lower your taxes. You collected the nice high rent. You collected the lease option money on there, and then you convert it to a note after that. Works beautifully. Notes in bankruptcy. A lot of real estate investors, when they see notes in bankruptcy, they run the other way. Notes in bankruptcy, we gravitate towards. When you buy, for example, a Chapter 13 note, it's gone through the Chapter 13 process, there's 2 payments instead of 1. You're paying the price for 1 and getting 2 payments. Free money. Even free money, really? You guys don't like free money? Free money. Imagine that. You're buying 1 note at a discount and you're getting another one for free. It's crazy. I've got some awesome examples. We'll be able to go through those in detail on Saturday for you as well. So we love those notes. The other one's Chapter 7. You have about a 99% of get the deed move foreclosure. It's called Chapter 7. So it's another way to quickly acquire real estate at a much better price. Performing notes are great right now. Reperforming notes are great. And seller financing, especially for affordable housing, is going up. And there's huge opportunities in affordable housing right now as well. And we're going to see more non-performing notes in 2022. And I'll show you all of those things Saturday, by the way, using real deals. What I'd like to do on Saturday is get away from PowerPoints and get into county records, get into documents, get into going through, so you really see how the business is done at a high level. I do this, as Lloyd was telling me, I do this in a very detailed method. We can't ignore all the things that are driving in front of us here right now: home prices, interest rates, affordability, seller financing, and delinquency rates. They're really all falling back into the note business. And I think if you understand that, you're going to see that there's more opportunities on the note side of things than others. I got some stats. I'm not going to spend a whole lot of time on these stats for you, but I do think that they are important. But most of these you already know just by being in real estate. Our housing price index, which is done by Black Knight Financial Services out of Jacksonville, Florida. It's one of the publications, by the way. It's called a monthly monitor. Black Knight Financial Services, I read it every single month. It's really good for the note industry. What they're saying is 19.6% growth in the home pricing index. So property values really have just gone through the roof to the point where a lot of people are starting to think it's got to slow down at some point in time. It's got to start to slow down at some point in time, because right now, based upon that number, average homes across the United States have increased in value over 34% since 2020. That's big, right? So enjoyable, but those have been around long enough. You also saw it can go the other way, right? Like 2008 did. Now we're in a completely different situation, which I won't go into, from 2008, but highest year-over-year annualized return on appreciation on record. So we are in historical records right now. In fact, January and February were crazy. 4 times over the 25 seasonal average, meaning it's probably overheated. In fact, the Case-Shiller Index, which has done a very good job, an accurate job of looking at all of these numbers, they are predicting that this rate of 19.6, you can see what their projection is, it's going to fall back down. This is not property values, this is appreciation cost rate, okay? I should say cost rate. They're saying that's going to drop down to about 5, a little bit more reasonable. But that was 2008 and 9, everybody, okay? So that's what the big fear factor is for a lot of folks right there. And I'm not saying it's going to do that, but their projection, at least for next year, is this hyper pricing index is going to start to come down, which also means when you're investing in real estate, when you're investing in notes, you need that discount in there. Our discount is much higher than what people are paying right now in real estate. I've seen people paying 89% of the as-is value for properties across the United States. And that's going to be asking for trouble at some point in time when things slow down. When you can come in and buy a note that's backed by that real estate, but you're in it anywhere from 30 to 70%, you've got more room, you've got more cushion, you've got more safety, and you've got the cash flow from that. Mortgage rates, we all think they're going to go up or down. Up, right? They're going to go up. Inflation's already up. Inflation's at a 40-year high right now. The Fed is working aggressively to combat that, which means they're going to be spending some more money, and they're going to be tightening lending up. The banks get into a fear position historically every single time that this has happened, and mortgage rates go up as a result. Today, as a matter of fact, I saw one study that is projecting the interest rates will probably be up around 7% for a mortgage pretty soon. Now, if you've been around an even longer time, and there's a whole generation that hasn't, by the way, in the the early 80s, I think the peak was 18.6%. I might have had it on here, 18.6% mortgage rate at a bank. So we've been way up there before, but most everybody now, when all of a sudden these rates went up just a little bit, the knee-jerk reaction is applications just dropped through the roof. Okay, now they'll start to trickle up here again, but we're going to see this. And every time there's been an adjustment like this, seller financing starts to fill a void. Okay? And again, this mostly impacts the affordable housing category. Right? That's who it impacts the most. They're going to need more and more help. They're not going to get it from the banks. A lot of banks have already pulled out of certain areas where they won't do loans because there's neighborhood stabilization programs where if you do a loan in this city, you have to do it everywhere. And some banks don't want to do that. So you have non-bank lenders that are starting to go in there, and they don't have to lend to people they don't want to in areas, I should say, that they don't want to on that. So there's a problem with affordable housing. Seller financing is the solution, because when we're creating notes for people, we can modify those loans to tailor to the person if it works on our end as well. I hope that makes sense to everybody, because affordability is the next thing here, right? All the prices are going up, inflation's starting to go up. Highest affordability in 15 years, 29% median income now is required to make your payment. Why am I going through all this? Because seller financing is going to be one of the other sources that you're going to want to tap into for note inventory. I think of note inventory as funnels. There's bank inventory that trickles to us. There's certainly REO inventory that trickles to us, and that's on the seller finance side. Big companies that go out and buy property in bulk, sell with seller financing, and eventually cash out of those notes. Another one is the so-called mom and pop notes. That's what we're seeing in these studies here by Advanced Data Services. Seller financing is on the increase, started in 2021. These numbers always have to take a little bit of time to work backwards, by the way. But 27.3 billion on the seller financing. Now, this is only based upon 2,200 counties, so it's a sampling of the overall what's going on there. Historically, these are the states right now that have the highest percentages of seller carrybacks, which is seller financing here. And historically, Florida, Texas, Arizona, and California have always been the top four. That's changed a little bit in this scenario here. And that's important to you as a note investor because once again, you can go and find note sellers, mom and pop note sellers in any one of these states by buying a lead list. And reach out to those folks. That technique is going to start to come back. Okay? Buying a lead list, reaching out, see if people want to sell their notes, because what they found in these studies was that there was more notes created by a single note originator versus somebody who's done it before. And they look at that number because they go, well, if somebody's done this before, they probably do it on a regular basis. So why are we seeing an increase in numbers? But it's really just by single people, because now you've got people who are trying to sell their home. They may not have wanted to do a seller finance note, but they needed to sell the property, to sell at a good price on a premium. And then something happens, they want to cash out of that note. You can provide them that money with your own capital, or once again, arbitrage. Okay? All right, more money down we've seen an increase in the average size of the seller finance loans. Those have grown as well. All right, another opportunity here, equity lock. I mentioned this one to you before, just briefly named it. This is a technique that real estate investors use, especially in situations like this, where property values have increased so much, you've got tenants in there. There's going to be a concern, if there's not already, when a landlord's going, you know, we're enjoying the high rents right now, but inflation, cost of living going up, food, gas, everything else, people are going to start to prioritize. And you've all seen enough of the laws and things like that have been passed in various areas. They've been very tenant friendly, and that can be a problem for single people who own single or several rental properties. So it may be time to step away from that perhaps and convert these folks over. And there's a lot of ways to do that. So these numbers are accurate in Houston, by the way, the last numbers I ran. So somebody got a home back in 2017 for $130 in Houston. They were renting it for about $1,400 a month. It's now worth $165. So what do you think is going to happen to prices? Well, if you think they're going down, why not convert this tenant over to a property owner? Right? How do we do that? Well, we lock in our equity. We can do it a couple of ways. We can create one big mortgage, and a lot of real estate investors do that and they make a mistake because they create one big mortgage and then they turn around and try to sell that mortgage and find out that they're going to suffer a big discount because they didn't put a high enough interest rate, they didn't do the proper term, that sort of thing. There's other creative ways that you can do this, for example, by creating two mortgages. With the goal being, I'll do a first mortgage of $65,000, second mortgage of $100,000. Their monthly payment is going to be about the same. So I'm matching the payments the best I can here. And this one's going to be for 180 months. That's going to be for $240. The goal is going to be, I'm going to sell the first one and I'm going to keep the second. So that enables me to pull out money from the property that I need or want. And again, I can change these numbers, right? I sell that note and then I can go ahead and keep the second note. So I'm getting monthly lump sum plus monthly income on the second every single month. Real quick. Okay. He said, what if you have a mortgage already on that house as a landlord? We'll talk about wraps. You can do wraparound mortgages. The numbers have to work. It's not going to work in every case, but there's something called wraparound mortgages that you can create still that way. Okay. So you've got this, you keep this. I had a client of mine in Arizona, when I taught him this strategy, sell first, keep second. He really liked that, and he took it a step further, and he said, well, if I can sell the whole first mortgage, I just really need $35,000 out of this. I'll just sell 71 of the 180 payments. It's called partial. So I'll get my $35,000 for that. And after this investor gets their 71st payment, the payments come back to me down the road. or there's an early payoff. Everybody gets a prorated share there. So he got the 35,000. He's keeping 109 payments. That's the difference here on that. If he gets paid out on that, you can see the number there. And then, of course, he's keeping the second on this as well. Creative ways to structure these deals to, again, if you're sensitive to prices and where you think those things are going, might be time to convert. Maybe you want to convert simply because you're tired of the landlord scenario. I have it all the time. Here's this lease option real quick for you. It can work on small properties. My client up in South Carolina has a small group put together now because he's a pretty seasoned investor at this point in time. And he saw a lot of investors passing up small value properties every day. You can't make any money in those. Can't make any money in those. So just to convince them that you could, he bought this double wide. Right? By the way, double wides and mobile manufactured homes, all those sorts of things. The largest creator and purchaser of manufactured home and mobile homes in the United States is Warren Buffett's company. Big money in it. He bought Clayton Homes, he bought 21st Century Mortgage, and he's making big money in that. So there is money in this space. Bought this with his IRA, $27,000, including all the rehab. Right, so he bought it. I didn't break the numbers down. He's all in at $27,000. Now he's I lost my joke there. I was going to say, now what he does is turn around and sell this, right? So he bought it cheap, fixed it up, sold it, and I was going to tell you that he's got a really creative marketing mind, and you guys might not be able to do it. This is how he markets. Right? He does very simple marketing. No bank financing needed, $5,000 down for sale by owner. That's exactly his signs. I can go out there and take a picture. So people come along, property buyer comes in, he signed a lease purchase agreement for $69,000. They're starting at $800 a month. She gets a $5,000 option money there. He holds on to the lease purchase agreement after 13 months, again, getting into long-term capital gains. She now decided to go ahead and buy it with seller financing. They already had prearranged. So now her payment goes down from the rent, goes down to $685. Okay, that's principal and interest. So she still has taxes and insurance in there, but now she gets all the tax benefits and appreciation and everything else. And he had the price there. So the note's going to be $64,900, 180 payments, 9%. $27,000 profit when we bought it. All right, let's see. Partials, arbitrage. How are we doing? Okay, we're in good shape. Let's see. This one was a. What was this one here I was looking at? Oh yeah, note arbitrage and partials. I think we talked about those enough for you. For this one, I'll spend more time on Saturday. What I'm showing here is a screenshot. So this was a note that somebody found, and there's a couple of ways you can go on these type of notes. This was a mom and pop note, 29.9, 9.5, and to the 129. He was able to negotiate a price of $23,000 for this note. And just to show you how these numbers work on a financial calculator, you don't think I'm making them up. So we've got a, make this bigger for you. These financial calculators are pretty easy to use once you understand them here. So 29.9 is the note. That's its present value. That's the unpaid balance in this example of what they owe. That note was written at 9.5% interest per year. That goes right there. Payments are $370, money out. So I'm going to put a little negative sign there. And that leaves it with 129.47 months remaining. Okay. So my client then comes in and negotiates to buy this note for $23,000. At $23,000, he's still getting $370 per month, and he's still getting it for 129 months. But because he's paying less than the present value, what happens to his yield? Goes up to 15.73%. Okay, I got 15.75 there. So that's the discounted yield. The note owner, or excuse me, the borrower on the note is still paying 9 or whatever it was, 9.5% interest, but because you paid less for it, your return goes up for those same amounts of payments. So he could have gone to another investor. So you lock this deal up on a contract, and then he goes to another investor and he offers it to this other investor at, let's say, $28,000, okay, which is still less than the balance. And that investor would get 11%. Is that a good return? Sure. And he could arbitrage that, making what? The difference between 23 and 28, $5,000. Another thing they could do is, if you had the money on this note, go ahead and do a partial on the note. So on a partial, what we're doing is just dividing a note up. I didn't put the current numbers in this one, so we'll just use this for the sake of time as a different example. I could change the numbers and all that. I forgot to do that earlier. But if we had a loan that had an unpaid balance here of $34,125, and it was 240 payments at 8%, the monthly payment there is $285. If you got that note for $26,515 to buy all payments, again, your yield's going to go up over here. Same number of payments. Then you could even sell that note to another investor who's happy with an 8% return. You could sell it to them for $30,500, but they're only getting 185 payments. Think about that one. So you're making about $4,000 when they buy, and then after they get their 185th payment, you're getting payment 186 through 204 for free. And the money in. There's a lot of ways we could do that. You could buy a note and just say, well, I don't want to sell that much of the note. I've got that investor who's willing to do it at 8%. I'll just sell them 145 payments. So I've got nothing in this note, but I got payment 146 or 204. So with these notes, with what they represent, we can sell different timelines, and that maximizes your returns on all of these deals. We'll spend more time, obviously, on that on Saturday as well, because I can tell with some of you that's gone right over your heads, but that's okay. This is a part of it. So recognizing what the yield that you can get, a deal has to stand on its own, but then we always look at what are my potential exit strategies on all of these deals. So certainly you can have several of these. Same example, I just took a screenshot of that one where you could just get it for 23 and then sell at 81 payments. You get the idea. All right. Non-performing loans. Let me show you what's happening right now. I'm going to go through these and pick it up a little bit for you here. Mortgage delinquencies by severity and everything is what this is showing. The delinquencies have gone down. Okay? There's no question about that, but they were pretty elevated here at one point in time. Foreclosures, you can see, have drastically gone down. Foreclosing for banks has really fallen out of financial favor because of the Dodd-Frank Act. The Dodd-Frank Act changed the foreclosure industry virtually overnight, because what they did was they set up penalties for banks based upon the percentage of non-performing assets on their books. So when they have loans on their books that are not paying, they're non-performing assets, if they get to 5%, it triggers an investigation. 7%, the Fed is going to implement penalties. Right? So they look at that, and when a bank is facing a penalty, the penalties are severe. They're 10 times, meaning, using small numbers, if a bank has $1 million worth of non-performing notes on their books, and they're at 5%, that's of their portfolio, they're facing a penalty of 10 times that, or $10 million that bank would have to put in cash reserve that they can't lend. Think about that. I'm using small numbers there, right? If it's 10 million, now we're looking at 100. That caused banks to say, we need to get away from foreclosures as the way that we liquidate these assets, and we have to sell the notes. That's why if you look up Fannie Mae non-performing loan sales, you're going to see that they still do about $8 to $9 billion worth of sales per year. Instead of foreclosing. Why? Foreclosing takes time. If you're that banker and you've got that $1 million on your books, what are you going to do? Get it off my books. So what are you going to do? Foreclose and have it take 12 months? And now you're gonna put $10 million in cash reserve for a year? No, get them off my book next month by selling them at auction. And that's one of the other funnels that eventually trickles down to us. That's why you can see right here where foreclosures really started going down. Most of this was because of Dodd-Frank. And right through here is where banks switched over, and the vast majority of the non-performing notes, non-performing assets are sold as notes, not foreclosures. Okay? That is a game changer. And you can see that in these numbers. I'm not going to go through those numbers, but in all of, no, not all, they ticked up a little bit here, but we only had in February, that's the latest number, we only had 25,000 foreclosure starts nationwide. That's it. All the rest is being sold through notes. So would you be rather looking at 25,000 nationwide, or you've got 2 million nationwide that are not current? COVID-related statistics. This is one government program that really worked. Now pay attention here, because this is a game changer for everybody in this room, and it's a limited time, as you'll see as I outline this. I've been tracking this thing since they started this program. We've had 8.1 million people go through this forbearance plan where they didn't have to make their mortgage payments. Everybody familiar with that? And it started as a 3-month program, went to 6, went to 12, went to 18, went to 24, and some people are getting extensions beyond that. Here's what we know statistically as of March. These are the latest numbers that are out there. 53% of those people, so 4.2 million people, have successfully come out of those plans and have had the ability to make their mortgage payments. That's successful. That's good. That's a good thing. We also had 28%, which is 2.2 million people, pay their loans off. It's interesting. How they pay the loan off? What do you think? Sold the property. Sold the property. Property value is up. We're in trouble. Sell it. We moved. We downsize. We move. We rent. Whatever we did. So collectively, I mean, you've got 28% there, 53% there. So the vast majority of people came out of this program successfully. The ones who are going to need help are the ones in active loss mitigation, the ones in delinquencies here, the one in active foreclosures. Those are the ones that are going to need help. Some will get bank help here. These won't. And then you've got the people whose term either got extended or they're under their current plan. So the unknown is how many of those people are going to have the ability to pay their loans or not when their plan expires. The estimates right now are about 2 million people in play for that. Now that's important to you because in addition to that, the government came up with this program called the Homeowner Assistance Fund. I took a screenshot of this website from the Secretary of State. You're only the 4th group I've ever told this to, by the way. Nobody else is teaching. They don't know about it. What this did under the Patriot Act is it distributed 9.96, let's call it $10 billion. Every state in the United States got some of that money. Okay? So 10 billion out there. The goal of this program is to help people stay in their homes. Now, if you're behind on a mortgage payment, you haven't made a payment in 2 years, you have built up an arrearage account. That's all the payments you've missed, plus taxes and penalties, or penalties and interest, I should say, on top of that. How would you stop a foreclosure if you were in that situation? If you're the borrower, pay it, right? Pay it, but you don't have the money. They'll pay the money on your behalf, not to you. They're not going to send it to the borrower saying, hey, don't forget to send that $25,000 to your lender. Okay? They send it right to the note holder to catch you up. They might look at your paperwork and say, we're going to catch you up, but we also see that financially you're not quite back on track yet to be able to afford these payments. So we're going to pay your mortgage payment for you for the next 12 months directly to the note holder. Or we don't think that you're going to be able to ever catch up on these payments. Maybe now somebody's on disability, they're on limited income, a fixed income, Social Security, or what have you. And maybe they're in a state that pays up to $50,000 and they only need $40,000 to pay the loan off. We'll pay off the whole loan for you. You might pay 20 grand for the loan. Hello? All right, let me show you more. So the 10 billion's been allocated. And here's an example to put some pictures to it. Got a property worth 60 grand. They owe 200 payments. The unpaid balance is $33,000. Very typical scenario in the Midwest. They owe taxes, property taxes, and they have unpaid payments totaling $25,000. Everybody got the scenario? Hello? Okay. You buy the non-performing loan for 20 grand. I'm using numbers that are very consistent with the Midwest here. So you buy this because it's non-performing. 33,000 is the unpaid balance. You're paying 24, but it's backed by a $60,000 property. Are you safe? Okay, we got safety in there. We do have a problem. We've identified that problem, and smart investors identify problems and provide what? Solutions. So our solution is, let's contact these folks either directly through us or our servicing company, third party, and let's have them apply for this program. So this is, I took a screenshot. What's this one, Alabama or something? Yeah, Alabama. They apply for assistance 90 days later. Okay, so every state, by the way, has a website, has a phone number, has the documentation that they need to fill out. Every state has that right now. In fact, this program's so new, everybody. 3 weeks ago, there was only 5 states who had their program approved by the Treasury Department. Now it's completely flipped around. I think there's only 5 states left that aren't approved. So most every state now is approved for this program. They apply right online, require documents. If they can't get access online, there's a phone number that these folks can call. So they applied. 90 days later, the state pays the $2,000 in property taxes. Now, as a note investor, is that important to us? Why? Yeah, that's one reason, right? Because it's less money out of our pocket. The other thing, we always have to be sensitive to property taxes, because they're the most senior of all liens in the U.S. Every state in the United States puts them in the front of the line, which means if we don't pay attention to that, potentially we could be wiped out of our investment if it's foreclosed for non-payment of property taxes. So it's important. So if the state didn't pay, you're right, we would pay that to prevent it from going into a sale. Now we can add that to the loan, et cetera, but that's beyond the point here. So not only are they going to pay the taxes on that, they're going to pay you $25,000. And the state's going to pay you the next 12 months of payments. Now, you bought the note for 20 grand. Irrelevant. What do they owe? They owe 25,000. That's underneath the state maximum here. So the state's going to pay us 25,000. You've owned this note for 90 days. Are you with me? What's your return now? You got nothing in it. Pay 20,000. You got 25,000 back. Plus, the state's paying you the next 12 months worth of payments, and guess what? You still are owed 200 payments after that. Hello? Yeah. Oh, sorry. They owe 200, my bad. 188 payments, sorry. Because the state paid you 12. See, here's the cool thing is, he said, who did you buy this note from? It doesn't matter. It could have been a bank, it could have been an REO company, it could have been a for sale owner, it could have been a mom and pop, could have been a company that creates notes with REOs. It doesn't matter. What matters is that the borrower was in trouble. The borrower applies. It's not property specific, it's borrower specific. They ran into a financial issue. And by the way, the other thing is they can't make more than 150% of the income in their zip code, which you're going to find that doesn't apply. We all think of that. You stunned? Hard to read. Hard to read you guys right now. Go ahead. Right. We still would have got paid if they did it on their own. Okay? But what he said was, I'm repeating for the people at home that can't hear the questions. The borrower in this house, he said they didn't know about this program, and he's correct. That's one of the problems with these government programs. They had one back in 2008 called the Hardest Hit Funds. And what we found was, it worked very similar to this, by the way, what we found was the people who need the program don't know anything about it because the government doesn't promote it anywhere. That's why I'm telling you, so you go, hey, we can help you. Send a door knocker for 75 bucks. Boom, take a look at this. It can save you all this money. And it'll pay it on your behalf. It'll catch you up. It'll take that thing we've been thinking about 24/7. You know, are we gonna lose our house? That's gone. Fill this out. Send a direct mail. You know, whatever you need to do, get on the phone with them. Have your third-party servicer call them up and apply. You know, but that's where you're gonna find it. Now, the second part that I answered his question, by the way, for those at home, is what if the borrowers found out about this and they filled it out on their own? We still get paid. We're the note holders. That's what catches them up. Yeah. So I've got people working on this right now. I don't know if I need to go through this, but you guys kind of get the idea. Same thing, but it answers still about your question. Where do we find this one? This was a note that, again, it was simply a property that was purchased back in 2013 under what's called a land contract. Okay, so a real estate investor owned this property, sold it to somebody with a land contract. So we had all the documents, went through all of this. The property, well, that was before the financing. Property's valued at about 80 grand. Same borrower since 2013. Now, she hasn't been perfect. In fact, it was a couple. And we noticed in the paperwork that one of the two original borrowers got a release of the loan. So I was like, what happened here? Because if I have two borrowers that sign on a note and one says, hey, can you take me off of there? I'm going to be like, no. There's no compelling reason for me to. You sign it. I'm buying this as is. But the boyfriend became such a pain that they decided it was the best thing to do. And it worked out because she stayed in the house. She was able to get a second job. She started to make payments again and everything else. And it's been there since 2013. So she's built up some equity in this property. Unpaid balance is $41,467, $369 per month. And this happens to be in Michigan. So in Michigan, I had people ask about, well, what about these land contracts? You can't do that program on land contracts, can you? Yes, you can. I know you can't see it, but it says right here, delinquent land contract payments, mobile home, consumer loan payments, mobile home and parking lot payments up to $25,000 per household. So in the process right now, as we speak, this note will stand on its own. This is what's owed. He purchased a note for $30,000. This is Brian. He lives in South Carolina. This is somewhere in the Midwest. This note on its own is making 14.45%. Good enough deal right there. He didn't buy this. I'm pointing this out because he didn't buy this just because he might be able to get this program. We never do that. It has to be a good enough deal on its own. If we get the program, that's just the extra. Right? That's just the super bonus that we're going to get there. So he's got a great note at that price, motivated seller. This note was owned by two people. And a lot of times when people do a joint venture on something, whether it's real estate or a note, everything's perfect until what? One starts to decide, well, hey, let's sell out. The other one goes, no, we're going to keep it. That was it. You know, you're running these problems. So these investors were kind of at a crossroads. We're like, well, we'll just sell it because this guy wants to sell and I don't, but we're going to sell it. Right? Motivated selling. Right? So imagine this. So here's the plan. He's paid $30,000 for this note. They're going to apply for HFA. Hopefully they can get the full $25,000 on that. Now he'll only have $5,000 in this note that he's got 315 months and $369 a month. We could calculate that yield, but good enough, right? We get it. Saturday. Got a lot more to cover with it. And we'll be able to spend some time on it and go through the documents. I'm going to take real deals, show you where we found them, what we looked at, what some of the problems were, what you can do, how we can parcel out them, how do we run the numbers. I get into details of these things with you, and it will be bring pen and pad. You're going to fill up a yellow pen if you take your notes the right way with me. And I would even suggest for those who are coming on Saturday, get yourself that this little calculator that I use. It's an application. You can get it for like, I don't know, $6 on your phone. I got one on my phone, my computer, everything. It's called the 10BII. Bring that because we're going to be using calculators in class, and I promise you it'll be fun with math. So if you know I'm not a math person, oh, you will be. when math is this fun. So it's called the 10BII financial calculator. It's got a little red circle with a silver 10BII on it, and it's a great financial calculator. We'll be using that in class as well. I may even have, I believe I'm going to have some live inventory. And so we'll take some live deals. And when I have those, what I like to do in a class is look at that live inventory the first time with you. And we'll see where it leads us, because that's really what the business looks like. It's one thing when I'm spoon feeding you, here's this, look at this. It's another when we have to discover that along the way. So we'll be able to get to that point for you as well. So it will be in intensive training. My understanding is it's in the room right back here on Saturday. We start at 9 o'clock and we go till 3 o'clock. Lunch is going to be provided. Same catering company as Lloyd mentioned, and we're going to have a box lunch. So I'll be there too. So we'll have plenty of time for Q&A and everything like that during the lunch hour, and get to meet each other, and I'd like to show you some more about what this business can do for you. And I hope you enjoyed that, everybody. How'd I do? How do you sign up, Lloyd?
You can sign up right on our website, STLREIA.com. There's right after this event, registering for this event, down below on our homepage. There's a link to register for the Saturday seminar. You can, because there is a charge for it, you can pay for it with a credit card right online. Or if you have any issues, don't try to do it now. Or you can see Laura. Laura has stepped out. She'll be back at the table here. She can help you with that. She's got a little square thing. We can take a payment and get you registered, or we'll even take a personal check if you didn't bring a credit card or anything like that. We'll make it easy. Hopefully, we can get you registered as soon as possible. So we got a good count by about Thursday or Friday. I got to get a final count on our box lunches, so we'll make sure everybody's covered. I'm going to bring our percolator along, have some hot coffee going, and should be a good day. Have water and sodas. So keep everybody hydrated. Kevin says bring a lot of paper and pens. So absolutely, he pours out the good stuff. So you want to take a few more questions? Oh, I didn't say that. It's only $39. Yeah, that basically we're a non-for-profit. This just proves it. We're just cover our box lunch and the extra room rental for the day on Saturday. So yeah, it's no big deal. If $39 is going to keep you away, you're probably not too serious about this anyway. But I know I paid a lot more than that when I heard him for the 2 weekends that I spent with him and a couple other guys back 7 or 8 years ago. It cost me a lot more now. It was like $1,400.
Yeah, I have to work Saturday. Are there any other options, like any other days, or do you have a Zoom or any other options for those who can't make it?
We don't. I know Kevin has a lot of other, I don't know if you offer programs that, I know you got a podcast on your website.
This one's going to be live only, unfortunately. We're not going to have it recorded. Yeah, so I don't know what to tell you on that one. I apologize. We're not going to have the ability to do that in there for this one.
Do you do similar training around other cities that you might be nearby, like in Chicago or something? I traveled to other cities to catch up with seminars that I couldn't miss here in St. Louis.
Buffalo. See me after if you can. We'll see what
maybe or something. Yeah.
Questions, anybody?
Okay. Anybody else?
Yes. Oh, he's got the mic. We got questions for people at home too. I don't know.
I just have a question. I mean, if someone defaulted on the loan to you,
Yeah.
do you have to go through this, like the eviction process, or how do you get them to pay?
She said if somebody defaults on a loan, I don't know if I might cut it off or need to throw a switch. Can everybody hear me okay? Yeah. Okay, if a loan defaults, somebody stops making payments, there's a series of events that start. You really don't take any drastic actions until about 90 days. Okay? So 30 days, your servicing company is going to be sending the late letter. 60 days, you're sending the stronger late letter. 90 days, hey, you guys got to really catch up. Otherwise, this and that could happen. So if they don't catch up, the slippery slope for the most part is 90 days. 30 days, people have a tendency to catch up. 60 days, they catch up. 90, we're in trouble, statistically. So when that happens, that's when you go into resolution mode, which is like, Okay, first of all, we've got to communicate with them through our servicing companies for the most part, right? You're not in the debt collection business, I don't think, right? So you can have your servicing company contact them, and under your instructions of let's send them a notice of intent to file foreclosure. Let's see how strong we need to make it. So sometimes it's as simple as an attorney head letter versus your company letterhead. You have the attorney write a letter saying, look, we're reaching out. This has reached 90 days. We need to hear from you within the next 30 days. Otherwise, we have no choice but to pursue other things such as foreclosure. So it's not a, threatening, but it's enough of a shot over the bow. If they don't respond to that, then we simply have to go down that foreclosure road. And at some point they might reach out, or maybe they don't. We never need anybody's permission to foreclose upon them. Okay, we don't need their permission. They have to break the contract, and we have to be able to show proof of that. So we have the legal right to foreclose. But it's such a small percentage in our industry where we have to do that, because for the most part, we're able to let people off the hook by getting a deed in lieu. And some of you have probably done this in regular real estate as well. You deed in lieu with cash for keys. Sometimes we've done, and that's another technique real estate investors use, right? When somebody says, hey, I'll sign it over to us, that sort of thing. So we try the best we can with resolutions. Of course, the government programs and other thing right now, but we try to, with our best of our ability, to keep them. But if they don't pay, at some point, you may have to foreclose, but it's a pretty small percentage of time. The only time that's different is when you know that the house is vacant and they haven't paid. If the house is vacant and they haven't paid, you're going to end up with that house. You're buying the real estate at that point in time. I've never had a single case where somebody's bought a non-performing note and the person's moved out of the house, and you send them a letter saying, hey, would you give us a quick claim? He goes, oh, well, I'll move back in and start paying. It's never happened. So you'll end up with the real estate that way, but that was your intent going in for the most part. Sure. Does any of this apply to property held in trust? What context do you mean on that? Can you buy notes in trust and things like that? Or I'm just trying to put the frame of reference of trust. The trust owns the property? Okay, so if a trust owns a property and the trust is a borrower, it's like any other borrower. All same things apply, because there's somebody in charge of that trust and there's a beneficiary of that trust. So it would be the same thing. We can also, on the other side of things, we can own notes in trust, but there's this quirky thing about notes. The note is actually considered personal property, not real property. That's why you can't go to the courthouse and look up a note. You can look up a security agreement. You can see mortgages, right? You can see deeds of trust, but you're not going to see a note on there, because notes are considered personal property, not real property. So it's not a part of real property records. So a lot of times when you buy notes, you get a personal property trust that owns the note, and you can do it that way. And that gives you the anonymity and all the other benefits of trust. It's a great way to buy.
Yeah, I'm sure I'd ask this. So just like, let's say a home buyer, somebody seeking to buy a home, if they dabble, delay too much, thinking about, researching, dwelling on it, they might miss out by 3 other people.
Sure.
Is this the same kind of thing in notes? Are we getting them from the source and we only have so much time to do our research, due diligence, do it, jump on it? Or what kind of time frame are you looking at in availability and competition?
Sure. So his question is, again, repeating for the folks at home. His question is, what about the due diligence that we have here? Because his experience has been, rightfully so, in real estate sometimes, if you've got somebody new who's going to take, 10 days to do due diligence, they want everything to be, just down to the dotting all the I's and crossing all the T's, they'll probably lose that deal in a competitive market, right? So is it the same way with notes? And the answer is yes and no. Not the perfect answer you're looking for. The answer is yes and no, because certainly there will be times that you're looking at assets that somebody else might be looking at. And if they get to it quicker than you, they get to it quicker than you. So that could happen because there's public platforms. You can go to a public trading platform, register on there and look at assets, but you're not the only one looking at those assets. So that can happen. That aspect never really bothers me too much because there's always more inventory. We have plenty of inventory for you to look at, and you're just a couple keystrokes away. It's not like you've spent time driving out to the property and you know, that sort of thing. You'll get your due diligence down. I think my clients now that have trained under me, and I go through my process, I do 2 layers of due diligence to expedite the process. And when you do it that way, you'll eventually get down to about 10, 15 minutes to see if it's a deal that you're ready to put an offer on. It can happen real quick like that. The other times you'll run into a scenario of competition is there are some bigger companies that sell notes on a bidding system, a blind bid. So you submit a bid. Some of them you submit the bid, and if it's good enough, you'll win that day. Other times they have a bid deadline where they look at all the bids that particular day. So how much time you invest in those is quite different than if you're looking at something else. But we, for the most part in our industry, can move quick and make an offer on something, but we're also going to make that offer subject to an acceptable BPO title report and further due diligence. So that's the key that gets us to enable, like, boom, let me get this deal, let me get it locked up, subject to those other expectations. And that's very common in our industry. I hope that answered the question.
What type of tax liability would you be responsible for?
Well, like everything else, you pay income taxes on income, you pay capital gains on capital gains taxes. So it's no different. In fact, a lot of people prefer when they sell a property to take monthly payments because then they only pay the taxes on the income as it comes in versus a huge lump sum. That's another reason you're seeing those high prices. Yes, over here. Right. Other side.
Hi, so when you own a property outright, you do seller finances or subject to, is that equal to a note being that you created a debt for the tenant / borrower, or is that different?
Okay, if you own a home free and clear and you sell that to somebody, are you creating a note? Yes, you're creating a note. If I own a home free and clear and I sell to somebody who's seller financing, I am creating a note. Point one, I'll come to those other ones. So when you do that though, extremely important that you create a note the right way. This is an issue with real estate investors right now that I have seen that I just like, oh, it's so painful because you took all the effort to create this note, you created a crappy note. You created a note at too low of an interest rate, made the term too long. You didn't paper it up the right way. You didn't service it the right way. And that becomes a problem for the note seller who didn't create it the right way. It becomes a okay thing for us because mistake, discount. And that's where sometimes real estate investors are shocked when they create a note and go to sell it and go, well, no, investors don't pay anything. Well, because you created a bad note. And here's how, this is why. We just did a portfolio of 10 notes. In these 10 notes, they didn't record assignments that they were supposed to record. They were missing some quitclaim deeds. They had lost some allowances of the notes. There were problems with it. They didn't have a clear payment history. You know, I showed you the PayPal example, but other people don't have any record. You know, oh, but the payments come in every month, they tell us, you know, these sorts of things. So it's discounts. The other parts, like doing lease options and things like that, when you create a lease option, you're not creating a note yet. If you have a deadline for that, like I was showing you, then you create the note. It's a lease during that period of time. But yes, notes include wraps and subject tos and all those things as well. Servicing companies, let me define that first. So servicing companies collect the monthly payments. They hold the escrow if that applies. And they also will keep a full accounting on that. And that's important. One of the problems that we're having right now, for example, is the people doing seller finance notes and not tracking the payment history properly. These servicing companies are regulated. Like one of the servicing companies, FCI, they've got $14 billion under management. And they will not board a loan right now if it's not clear what that payment history is, because they don't want the borrower coming back and say, wait a minute, I paid that, I did this, I have proof of that. Now, there's solutions to that, estoppel letters and everything else, but that's all a servicing company does. A loan originator is who you're looking to work for. So one of the things we do, for example, when we create seller finance notes, we do want to make sure that they're Dodd-Frank compliant. And that's another mistake real estate investors make because they don't know what the Dodd-Frank Act is because it's on the finance side. The Dodd-Frank Act told even people who do seller financing, you have to show that they have the ability to pay the loan. How do we do that? We need to look at their income. We need to look at their debt. So they need to fill out an income statement or a balance sheet. Now, there are RMLOs that will do that. I use one called Call the Underwriter, who's licensed in every state. And for $500, he'll make sure that that borrower is Dodd-Frank certified. That adds value to your note. If you don't have it, people are looking at your note, and here's what people don't know. If you do a seller finance note and it's not Dodd-Frank compliant, everything could be fine up to 3 years. Sometime within that third year, the borrower defaults and the borrower lawyers up. And the borrower's lawyer says, well, wait a minute, did they look at your income? Did they go through the Dodd-Frank Act on this one? No, I never gave them anything. I just gave them a down payment. They created the note. Aha, they didn't prove you could afford it. Therefore, we're going to sue them for that. And they'll have to pay you back every single penny you paid them up to 3 years. Kind of important. That was worth $40 right there, right? That's worth way more than that. All right, what else do you have? Yeah. I just did. No, I just did. Yeah, sure, we can cover that. But that's the gist of it. Yeah, oh, totally. Totally. You even want to bring one, maybe I'll use it in classes and exam.
If you're financing if you're creating a note to another business, do the Dodd-Frank rules apply still?
Good question. He said, if I'm creating a note for a business, so I'm an LLC and this investor is an LLC and I'm creating a note for them, Dodd-Frank does not apply. Thank you.
Just
Investor,
homeowner.
investor to consumer. Yeah,
Consumer.
investor to consumer
Homeowner.
is Dodd-Frank. Yep. Glad you brought that up.
The last seller financing deal that I dealt with, the title company did all that paperwork after we agreed on that.
Great.
Is that not a standard procedure?
You could do it that way. You could do it through a loan officer. You could do it through a title company. Not all title companies offer that service. You can do it through a real estate attorney as well. But again, not all real estate firms offer that service.
You're suggesting, I mean, your program is taking it out of their hands and doing it a different way. Is that what you're proposing?
No, I'm proposing that you do it the way that you feel is the best. What I can give you are the options of you can pay $500, have this guy do it, you draw up the paperwork. The paperwork's all template today. I mean, let's face it, all the other documentation, you can do it yourself. If you prefer to outsource that because of time and you just don't want to deal with it, you want to be sure it's done the right way, then I would say, yeah, use a local title company or use a real estate attorney. Sure. Yeah, I bet there's real estate investors, you don't like to write your own contracts, but a lot of real estate investors do. They'll write a contract and put the car, right? So. Yes, in the back.
Probably answered it and I didn't understand, but the note without the underlying deed of trust or mortgage is useless, right? It's worthless. It has to have the underlying instrument. How do you make sure that when you are dealing with?
Sure. If it's a bank originated loan, it's going to be there. If it's an investor originated loan, it's going to be there. Could there be a situation where somebody didn't know any better and created a note and didn't have a security agreement with it? I suppose I've never really seen that before. And I've bought notes that were written on spiral notebook paper, but there's always a security agreement with it. So we'll verify that. That's part of what we do in our due diligence. And that's the part that is recorded.
Does a title company do that, or who does the due diligence? It's the same thing. Is there
the due diligence? The way that is optimal I like to think of it this way. When somebody's selling me a note, in a way, I want to know more about that note than they do. So I go through a due diligence. Now, again, I do a multiple layer due diligence on that. So I know what's there. And that way I can ask questions like an attorney that I already know the answers to. And I'm testing to see if they know the answers. I also can see if there's mistakes that they have made before I lock into a deal. But eventually, almost every single time, you'll also get a title report done. Yeah, so title company will do that report. Now, the way we do it is there's a company that I've known the guy for 15 years, Dickie Baldwin, and I go through his company. One phone call, I can get a BPO and a title report done anywhere in the United States. It takes less than 3 days in most all cases. So that'll be my backup just to make sure, but there's certainly, what title companies do is look at public records, right? So if you have a good public records in an area, which you don't have in all areas, then you're not going to see anything different on those title reports. But a lot of times we still get them just in case.
Thank you.
Sure. Most all the time.
Okay, anybody else got a question? Kevin? All right, I see it's about 9 o'clock. Appreciate you coming on board. Sure you'll stick around and answer any other questions. We got through until 9:30. I recommend you go ahead if you want to go ahead and register and pay through our website, STLREIA.com, or see Laura. She can help you with it if you have any problem. So look forward to seeing you on Saturday.
Thanks, everybody.
Thanks, Kevin. You want to read first too? It's just down the hall, the Gateway 500 drill. It's on that yellow paper. Okay.